Welcome to Asset Coach and Tax Strategist, our YouTube channel. Thank you so much for being here and watching us. If you're a subscriber, hey, thanks for joining us. If you're new to this channel, great, welcome. Go ahead and hit subscribe. If you like our content, give us a thumbs up, add a comment. And if there's any material or topics or conversations you want us to cover that you find of interest, let us know. We'd love to have that dialogue and conversation. So one of the things I want to do is I'm going to share my screen. I'm so excited about today's episode because I'm going to talk about Warren Buffett. Most people think Warren Buffett is this old crotchety guy. What's him and Charlie Munger know? And they're actually starting to get a little more attention of late because of their age and what Berkshire Hathaway is doing now. And usually when there's down economies, or more importantly, or more accurately, the stock market goes down, Wall Street, and everybody says, oh, Warren Buffett has lost his edge. His stock portfolio is doing this. But they don't understand what Warren Buffett's doing. They don't understand his approach to business. And he's been very specific. He's been very obvious and public about what he does. But for some reason, when you say Warren Buffett and you say he's losing money, it's clickbait. It's clickbait. That's all it is. They're using Warren Buffett as bait. And well, good for you guys. But I'm here to say I love his brilliance. Him and Charlie Munger are freaking brilliant. And I'm not talking about picking public companies or companies to buy and stocks and all this kind of stuff. I'm talking about the use of money. Think about it as a business owner. What makes your business so valuable? It's your cash flow, right? It's your product and service that you're offering, the revenue, expenses, the cash flow, what you do. What do you do with that capital? What do you do with your liquidity? What do you do with your cash flow? Warren Buffett, over his career, has been a master at that. By the way, those same professionals, air quotes, in this stock market and analysis that say Warren Buffett and Charlie Munger are all washed up and blah, blah, blah. Well, guess what? Those same stocks that he's losing stock price value on still yield him well over $1 billion a year in dividends paid to Berkshire Hathaway. So none of those financial professionals that talking about Warren Buffett's all washed up can say the same. Plain and simple. So, but that's okay. Usually that's the case, but let's talk about what's even more importantly, what this episode, this topic is, and I'm so excited about this, is how Warren Buffett uses insurance float to become so rich. Now it says used as past tense. Nope, not used, uses. It is a proactive activity that is annual. Okay, and so we're going to go through some examples, and this is definitely something that is very important to understand in the planning process. And you and I, as small business owners, have the ability to do the same thing. Just a little bit different, though. Well, not a little bit different, a lot of different, but we'll go through that, what that looks like. So this is an article that was updated February 2nd, 2022. So a little dated, right? A little over a year. But again, this isn't used. This is not past tense. This is active. In fact, you can go to every shareholder meeting that Warren Buffett has for Berkshire Hathaway. He talks about insurance flow. He has coined this term. So when you type in insurance flow on Google, guess who's going to pop up? This guy's mug right here, this guy, Warren Buffett's going to pop up. Okay, so let's go through this. Okay, most people know about insurance industry terms such as premium, and that's money that you as a policyholder pay every month, right? You negotiate with the insurance company the coverage for the type of coverage, whether it's auto, commercial, liability, whatever it is, right? And what the insurance company does is they take that premium, and a portion of that goes to pay for claims, reserves. Now, the claims it's the money that insurance companies have to pay out to abide by that contract. It's an insurance contract. It's an obligation to pay out if it is proven to be true. Okay? Not guaranteed. It has to be proven as a real event that occurred. Now, do you know what happens to your paid premiums once they are actually sent to the insurance company? No, nobody does, right? Because you don't even want to pay it. Why do you care where it's going, right? Now, we do that with taxes, right? I'm originally from California. It's like, what are they doing with our taxes? The roads are torn up. You have this over here, you have that over there, and schools are underfunded, they're crumbling. I pay all this money in taxes. What's happening? Right now I'm in Texas. They collect taxes differently. Now I see these beautiful schools. I see new roads being built, and all this stuff being corrected and fixed. I'm like, wow, big difference when it comes to insurance as well. So now insurers. So what happens here is that when insurers, meaning insurance companies, they don't pay out all that money that they collect right away, right? So when you pay a premium, a portion goes to expenses and a portion goes to reserves to pay for those potential claims. Now, your policy coverage is usually a certain time period, okay? At 12 months. It could be a claims made policy or an occurrence, when the occurrence happens or when it was made, okay? Then that definition, you have to go to the insurance agent and find out what that definition means and what that means to you. Occurrence is for some coverages, claims made is for others. Go figure that out on your own. This is not an insurance class. All right. So an insurance company will collect money in the form of premiums, right? Which as a business owner is a tax deductible expense to you, right? It's a cost of doing business. They invest that money, the insurance company invests that money, and then they pay out claims when those claims happen in the future, right? So the difference between the premiums paid and the collected claims paid out is called insurance float. There you go. Now, Warren Buffett describes and explains this. This is a word-for-word description in his corporate meetings, shareholder meetings. Okay. Now, it's a lot like how a bank will collect deposits. They invest that money through loans of other people, credit cards, all that fun stuff, and then they repay your money at some future date when you eventually make a withdrawal. Okay. And the Federal Reserve will come in and support and guarantee the banking loans. Well, no one guarantees the insurance loans. Okay. The insurance industry guarantees the insurance industry. The Federal Reserve, the bank who creates money, will back up banks. Okay. Now, insurance float has been a huge contributor to why Warren Buffett's success with Berkshire Hathaway. Well, the act of insurance float, what has been a huge contributor to the success of Berkshire Hathaway, is Warren Buffett. Okay. His ability to look at something and say, can I, could I, should I will. Because premiums received are essentially like loans from a policyholder, right? Now, not all, they get paid back to the policyholder if there's a claim. So if there's no claim, does the policyholder get the money back? No. Now, there are some insurance policies out there, more advanced and more risk specific, specifically in like excess and surplus lines in certain areas where it's not traditional insurance, like what we're talking about here. They'll have a return of premium feature over a period of time, no claims. The insurance company could return the premium. Okay. And that's unusual. All right. We work with a couple companies that are like that. But I just want to clarify that he's saying it's like loans, but you don't get your money back unless there's a claim in the future. Okay. Now, Buffett has been able to use insurance float as leverage when investing in stocks and private companies, which has a significant and positive impact on the company's return for its shareholders. So it's called investment income. In the insurance laws and guidelines, you're allowed to use money. So you have to have a certain amount of cash equivalents to pay short-term claims that are occurring. So you know what that is based on the actuarial numbers and the algorithms of when you bring business on. Okay, this is the whole insurance business. And when you have dollars that are above that, you are allowed to put those into other types of investments. Now, you can put your cash equivalents, so like in treasury bills and treasury bonds, which is a great idea right now with interest rates being high. They're earning 5% on that short-term money. So that's great. When before it was like 1%, if anything, right? So now they're starting to see some investment income go up when it comes to these higher interest rates and inflation and the Fed raising rates. Now, on the rest of the money, they're able to use these monies in other ways. Okay, so Let's see here. Boom. Okay, it's part of the reason why Berkshire Hathaway book value and market value have grown 20% a year since 1965. And we'll show you numbers. And this is versus the S&P 500 10% a year, including dividends. Okay. So again, we do this presentation with some of our clients and some of us strategizing that we do with some of our clients. If the client, it's a right fit for the strategy. So this is important information, right? Knowledge is power. Implementation of knowledge is power. Just having this information doesn't mean anything, but how do you implement it? That's the key. That's what we want to talk about, okay? So let's take a look at it. Warren Buffett and Berkshire Hathaway's insurance float. The insurance float represents an available reserve or funds available for investment once the insurer has collected premiums but is not yet obligated to pay in that claim. Okay. Now, again, there's different algorithms and structures of what short-term, long-term, and all that fun stuff based on actuarial numbers. But in his 2002 shareholder letters, so what I say, his shareholder letters, he says this. So back in 2002, and every year, this is a conversation. So this is very public information. This is not brand new. To begin with, this is Warren Buffett. To begin with, the float is money we hold but don't own. In an insurance operation, float arises because premiums are received before losses are paid, an interval that sometimes extends over many years. During that time, the insurer, the insurance company, invests that money. This pleasant activity typically carries with it a downside. The premiums that an insurer takes in usually do not cover the losses and expenses it eventually must pay. Okay, so premiums are lower than what most claims and losses are. So an insurance company has this period of time to try to take these monies and make more money. Or if that wasn't allowed, what would happen? Your premiums would have to be higher, right? Plain and simple. Okay. And if premiums are a certain cost, then you as a person, claimant, will probably self-insure and not buy insurance and premiums because of the costs associated with it. So there's certain functions. The premiums that the insurer takes in usually does not cover the losses and expenses it eventually must pay. That leaves it running an underwriting loss, which is the cost of float. An insurance business has value if its cost of float over time is less than the costs would otherwise obtain funds. Well, how does a company obtain funds? Increasing premium, borrowing money, buying other companies, which just delays this because you have to buy the right company. And typically companies that are for sale aren't necessarily the right company. So you got to go buy a company that's usually larger and successful, and the cost is going to be more, right? So how do you obtain funds? Increase your premiums or borrow money. But the business is a lemon if the cost of float is higher than the market rate of money. So for example, if your cost is 2% of float and the cost of money is 4%, right? There's that difference that he's talking about. So you got to make a decision on what to do, or vice versa. So insurance float is the difference between premiums received today over claims that must be paid in many years in the future. During that time, the insurance invests the money. Insurance float is so valuable that insurance companies often operate at an underwriting loss. That is, the premiums received are not enough to cover the eventual losses, hurricanes, accidents, etc., that must be paid, and the expenses required to resolve those claims operate in a business. So why would an insurance operation be at a loss? Well, because the insurer can invest the insurance float and make even more money or increase premiums. What do you want to do as a consumer, right? So in this sense, insurance float is like a loan, and the underwriting loss is like the interest rate in the loan. And so when we work with our clients and developing insurance float for our business owner clients, that's exactly what we're looking at doing is how do we structure this as a loan? Because why? Loans are very easily documented. Insurances and coverages are easily documented. You have an underwriter, you have actuarial numbers, you're working with an insurance company. And then loaning features, you have to have contract and agreements with loans, right? It's all documented. What do I say in other episodes and other conversations? If you're familiar with watching anything I talk about, is that anything you do, you need to have paper proof and documentation of why you're doing it. Act like you're in the court of law. The judge asks you a question and you answer the question with your words, but no physical proof, evidence, Hey, you know what, Bob, you're a nice guy. You got a friendly face, but sorry, I can't take your word for it. Do you have any evidence or proof? And that's what the documentation does. So you got to find areas when you're doing stuff that the documentation is provable, and it's not your documentation, meaning that it's not you writing out the numbers. It's third parties that are incorporated with yours, and you have a methodology or a process. Can't tell you how important that is. How important that is. Okay. Now you can look at 2016 where he talks to shareholders. This is fascinating. So let me increase this a little bit more. Okay. So we're going to walk through this. So I'm not going to go through all this. His words talking about the P&C industry, collect now, pay later. Has them holding large money. We call it float, which we eventually goes to others, blah, blah, blah. Okay. But this is a result. I'm going to grab my writing tool. This is a result of his. So in 1967, okay, 1967, they bought National Indemnity Insurance Company. Okay. They bought it for $8 million. Okay. And it had 19 million in reserves. So Warren Buffett said, hey, I'll pay you 8 million and I get access to 19 million. Now remember, it's in reserves. What is it on a financial statement? Liability. It's got to pay claims. That's not an asset unless you use it as float. And this is what started Warren Buffett's journey. And so in 1970, he had 39 million. 10 years later, he had 237 million. 10 years from there, he had 1.6 billion. 10 years from there, 27.8 billion. 10 years from there, 65.8 billion. You see the pathway. Now, what happened late 70s, early 80s? Double-digit inflation, right? We had Reagan come into, we had a recession. We had Reagan comes in. We had in 1987 Black Monday, and the market dropped in October of 87. In early 90s, what did we have? We had recession. 91, we went into the first Gulf War. In 99 to 2000, what did we have here? We had 2000, 2001, we had 3 consecutive years of negative market. In 2008, we had the Great Recession. So between 2007 and 2009, we had a 50% drop in that 18-month period, right? You see the pathway here. But what happened? Not to Warren Buffett. What did he do in 2008? Remember this, 2008? 2008, Great Recession. What happened? Well, Warren Buffett basically had money. They had cash. They were sitting on cash. And so you remember what he did with Goldman Sachs? Goldman Sachs shares were down to $4 a share. And Goldman Sachs shares were down to $4 a share, and they weren't hemorrhaging, but Lehman Brothers just went out, right? You had some other financial institutions going out, right? It's the great financial crisis. Government created this too big to fail. And they created this whole guidelines and regulations of, we have certain financial institutions that are so big, if they fail, it destroys the world economy, right? And based on the calculation and the algorithms and the methodology and the formulas, Berkshire Hathaway was one of those. Government knocks on their door, knock, knock, knock. Warren Buffett says, hello. They say, Mr. Buffett, just want to let you know, Berkshire Hathaway falls within our formulas of being too big to fail. You're going to owe X amount, or you got to put certain amount into reserves, and basically costs go up. So what did Warren Buffett do? Well, he went to Goldman Sachs, gave them some money, got some preferred stock and shares back, and for that, an interest rate. And then he also went out and bought a railroad company. He bought the largest railroad company. Why? Hard assets. What do you get to do with hard assets? Depreciate them. Which railroad company is the most profitable railroad company today? Warren Buffett's. And that was all from action of 2008. And here we're in 2023. Okay. So having access to funds and cash flow is extremely valuable and important. It's what you do with it that makes the important note. What you do with money, what you do with cash, what you do with your liquidity, what you do with your capital makes everything. So one of the analogies I like to use, okay, so assets create income, right? And your business is an asset, you're an asset, real estate's an asset, your retirement account's an asset, stocks, bonds, mutual funds should be an asset, right? Everything's an asset that should appreciate and grow and produce some sort of income later on, whether it's an immediate income now or later on income where it's a capital gain from a sale of an asset, okay? So you have all that, right? So that's awesome. But what happens is that we have rules and regulations, and some people get to abide in some areas and some don't because of their income or their net worth. And so the Securities Exchange Commission has these accredited investors, non-accredited investor rules, and all this kind of stuff. Okay. But rules and regulations are bank on a river. So think about that. Okay. So you have a bank on a river. Now, do all assets act the same? No. They don't. So for example, let's use farming as an example, right? So if I want strawberries, if I want corn, I can grow the strawberries, plant them today, and then wait a few months for them to grow, and I can harvest them, and I have strawberries and I have corn in a short period of time. So that's that asset. But what about nuts, citrus fruits, grapes? Right? If I planted today, I'm not getting anything today in the next few months. I have to wait a period of time. And some assets are like that, right? And so too could be your business. But when those assets mature in time for harvesting, then they yield a lot without a lot of work. It's already been planted. They just got to go through growing season versus strawberries and corn. You got to go through the process of harvesting and then planting and harvesting and planting and harvest. And you go through this process, right? Some assets, some harvesting don't do it. So in assets, the same thing works. Okay. So you have stocks, bonds, mutual funds that could be like strawberries and corn. You have real estate that could be like grapes and citrus fruits. Your business could be both. It could be strawberries, depending on your business, or it could be grapes. It could be you could be yielding something more later on. Like Amazon's a great example. Made a killing, but for 20 years they showed a loss for 20 years. And after that 20 years, what happened? They become one of the most valuable companies. Have made the biggest difference among wealth and individuals and utilizing their platform. And Jeff Bezos has become one of the top wealthiest people in the world. Okay. So the banks on the river allow us to stick within these rules and these guidelines. Now, not all rivers flow the same. Some flow fast, some not so. The same with your assets, the same with the velocity of your money. So think of the flow of water like the velocity of your money, your cash. How do you accumulate cash? We stay within the banks. Okay. Now, if the banks weren't there, what would happen to the water? It would spread out and it would dissipate eventually, right? So the banks give it guidelines and direction, okay? And now you get to dictate the flow of your cash flow based on your assets, okay? And that is what Warren Buffett's doing, based on the assets. So when you go to Berkshire Hathaway and you look at the list of the companies they have, they're a conglomerate because they look at these different companies and see how they work with each other in Berkshire Hathaway's world versus separately, okay? And he believes so much in this when he bought his National Indemnity in 1967 for $8 million. Now he has 10 insurance companies. Yes, 10 insurance companies. So imagine that first 19 million he had in float to now he has well over $147 billion with an average of 20% growth year over year since 1965. So brilliant strategist in the use of capital, use of cash flow, brilliant strategist in use of assets and and that's what we want you to do. We want you guys to be able to do that. As business owners, you have the ability. Sure, we are not at Warren Buffett's level, but those rules, those guidelines, that structure still exists for all. For all. How do we do that? And that's the question. That's what you need to research. That's what you need to look. If you have questions on that, feel free to reach out to us. We can help with that at Terra Firma Business and Financial Consultants. That's the whole point of being an asset coach and tax strategist. The name of this YouTube channel is to help figure out, how do you get your assets, that flow of your river, how do you get that speed to increase? Okay. So, hey, if you like this content, hit subscribe, share it, give us a thumbs up, add some comments. Again, sharing it means taking that little crooked little arrow, clicking on that and texting that or emailing that to everybody you know and say, hey, take a look at this. All right. Thanks so much for joining us. My name is Robert Wolf. I'm the CEO and founder of Terra Firma Business and Financial Consultants, and I'm an asset coach and tax strategist. Make it a good day. Bye-bye.